Welcome back to Alternative Angles, a Fidelity podcast where we hear from investors about complex strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. In 1687, Isaac Newton published Principia, his book that laid the foundation for classical mechanics through the three laws of motion. The first of those laws, explaining the concept of inertia, says that absent an external force, objects in motion tend to stay in motion, while objects at rest tend to stay at rest. In other words, inertial trends persist until something alters their course and sends them on a different tack. Likewise, investors in managed futures, the topic of today's episode, use an inertial trend-following framework to observe movement and detect changes in the direction of financial assets. It's a strategy in which quants construct models to spot the price path persistence of a security, be it a stock, a bond, a currency, or a commodity, and then they ride the directional price drift until the model indicates the trajectory has been disrupted by an emergent force that ended the trend. With me today to explain the approach is Fidelity Portfolio Manager Rob Croce. Rob has a PhD in economics and has spent the last 15 years investing in managed futures. Along with his team, Rob has built a differentiated and disciplined systematic strategy that aims to identify price trends. The goal is to deliver capital appreciation across different market conditions and attractive risk-adjusted returns during periods when stocks sell off. Even so, managed future strategies, which employ commodity interest trading, can be volatile and involve a substantial risk of loss. My discussion with Rob is for educational and illustrative purposes only and is not a recommendation or a solicitation to buy or sell any securities. Rob, welcome to Alternative Angles. I'm looking forward to our conversation.
Me too, Steve. Thanks for having me.
Sure. So while I'm familiar with your background, how about you take a minute or so to fill in our listeners by telling us about your career path and what it was that led you to gravitate to a systematic investing strategy such as managed futures?
Sure thing, Steve. Life is so path dependent. Growing up, I was always interested in the markets. I had a feeling I would do something that involved the markets. And in college, I thought that might look more like trying to emulate value investors like Warren Buffett. I was very interested in economics, so I went on to do a graduate degree, a PhD in economics. And during that, my last year of PhD, I went and worked at a very large public plan in Texas, and I was on their strategic research team. It was my first exposure to how institutions use quantitative methods to inform their investing, and I fell in love with it then and there. My project involved modeling risk and modeling returns in a bunch of different markets that I had never even really heard of as a student of economics. And so my first job coming out of graduate school was to go and work for a small asset manager and to begin to work on these strategies directly.
Thanks for that background. How was it that you got to Fidelity?
Fidelity has been something I've been interested in for a really long time, a firm I've been interested in. And the reason is because I think that alternatives, in order to be relevant to a broader audience, have to be a part of more investors' portfolios. And we have to find a way to be relevant beyond just big public institutions. And so a firm like Fidelity that has such a foothold was, of course, very interesting as a potential home for running managed future strategies.
So as we get into the Q&A, I want to lay a foundation for us. And so how about if you speak to us about the core components of managed futures to get everybody up to speed?
So managed futures is a long-short strategy that invests in virtually all liquid markets. It's capital efficient. It uses derivatives to get its exposure so that it can access a very broad and diverse set of markets. And I think the key features are that it's totally systematic and disciplined. So we build models. Those models determine whether markets are trending upward or downward, and those inform our positioning day to day. There's not a lot of how we feel going into our positioning.
What are the features and the return profiles of a managed futures strategy that would lead an investor to consider adding it to a multi-asset portfolio?
I think that this is the key question, Steve. When I was working at that first job out of graduate school, I remember our CIO, or our chief investment officer, telling me about managed futures, and I said, "Well, what's that?" And He said, well, it's a trend following strategy. And I said, again, well, what's that? In economic theory, markets adapt instantaneously to new information. And so when he explained that managed futures basically buys things that have gone up recently and sells things that have gone down recently, I thought it was the most ridiculous thing I'd ever heard. And so I went and I modeled it. And I went running back to my boss and said, to show him the results, like, look at this, Steve. That was the beginning of what's been a 15-year path down this road of trying to build managed future strategies that meet investors' needs. And so what do we think those needs are? Well, first and foremost, managed futures is among the most uncorrelated types of strategies you can invest in. So there's a lot of different alternatives that are available to investors. But when we think about a portfolio that is largely driven by equity-like risk, managed futures, because they're so lowly correlated to equities, end up being something that reduces a portfolio's risk. So we think that they are among the premier potential diversifiers to an investor's portfolio. They make a big difference when you add them to a portfolio. So that's why I became very interested in these. That first boss really like to focus on what matters in a portfolio rather than fiddling around the edges. And he convinced me that managed futures matter very early in my career.
Yeah, managed futures sure can matter. And historically, that's occurred during some of the difficult periods for stocks. And while, of course, past performance is no guarantee of future results, can you speak to a couple of episodes when the strategy was particularly helpful to investors?
Yeah, I think investors do look to managed futures to perform in really challenging environments. And historically, in about 2/3 of periods when equities have been in real drawdowns, managed futures have done well. Good years to point to are 2022, when neither stocks nor bonds did well. And bonds were not there to bail out an equity investor. They did not smooth the equity investor's portfolio. Managed future strategies were up between, depending on the strategy, between 20 and 50% that year. And higher volatility versions of the strategy were up even more. So in a year that was very challenging for virtually all traditional asset classes in 2022, managed futures did great. 2008 was another great example. In the early 2000s, there was another great example around the dot-com bust. Managed futures have been there relatively reliably in periods that have not been good for traditional markets. Now, I say relatively reliably. Managed futures are not a contractual hedge. We're not buying put options. And as a result, so they give you a strategy that has a positive expected return. In fact, we think they're an expected return that's as good as those of a portfolio of stocks and bonds. We think you're just reducing the risk of your portfolio overall. And that's a unique characteristic for an alternative. Many alternatives seek to increase your return, but also increase your risk. Others seek to reduce your risk, but also tend to reduce your returns. Managed futures, so they are seeking really to keep your return the same, so you don't have to give up anything in order to reduce your portfolio's volatility.
Yeah, as you point out, Rob, a number of the strategies in the index, the SocGen Trend Index, have produced crisis alpha for their investors. Of course, the performance of any given managed futures strategy may vary significantly from the index, which I'll add is not investable, and it's not necessarily representative of all the managed futures strategies that are out there. But with that, Fidelity recently introduced its ETF in the space that you were instrumental in designing. In fact, Rob, you had a rare opportunity to create a managed futures investment vehicle from scratch. So, in putting it together, what were your goals and objectives that presumably reflect your investment philosophy?
So first and foremost, we wanted the strategy to be trend following. We wanted it to have those defensive characteristics. However, one of the things that I think has made managed futures something that's been challenging for many investors to hold for long periods of time is that in good environments for traditional assets, they tend to really underperform, right? They're not long stocks on average. So, when stocks are up 25 or 30% in a year, you may forget why you own managed futures. And so what we wanted to do was create a strategy that held up better and produced better outcomes in those positive environments without relying on putting equity beta or other risk on types of exposures into the portfolio. So that was the core philosophy. It had to be a full-blown institutional style strategy, the same types of instruments, the same number of instruments that we would put in an institutional portfolio, the same level of sophistication and trading speed that we would put in an institutional portfolio. But really, the thing that we wanted to express differently here than a pure trend following strategy was we wanted to have it do better in the positive environments where trend has really sort of let investors down historically. And so the way that we did that started from the insight that the benefit of managed futures has come mostly from the fact that they're either long or short stocks, or long or short bonds, or long or short commodities during those periods of time when markets were under pressure. It wasn't from relative value bets based on relative trend within asset classes. And so put that differently, it's really the market timing that comes from trend that generates defensiveness. And so within asset classes, we trade something like 150 line items today across stocks and commodities and fixed income and short-term rates and developed market FX and emerging market FX. So there's a lot of different places that we play. And within each of those, there's the directional positioning. We're long stocks today or we're short stocks today. And there's the relative value positioning. Let's say I like the S&P 500 better than I like the FTSE today. So that relative value positioning turns out is not where the defensiveness comes from. So we actually can source the information that informs that decision based on something other than trend. So within our asset classes, we're able to use a number of different sources of information beyond just trend to inform our positioning without affecting the strategy's defensiveness. Because the amount of beta exposure, or the amount we're long or short within each asset class, is totally determined by trend. And then around the edges or within the asset classes, we source that exposure to the asset class from places we think may be a little bit better or a little bit worse if we're short, based on other information.
As you talk about setting up this fund, it reminds me that at several points in my career at Fidelity, I also was involved in establishing new investment products. And I certainly appreciated all the resources that were available that I could then bring to bear in managing those funds and accounts. And so I'm curious, now that your fund is up and running, what are the key tools you're relying upon to execute as best as you can?
So, at the risk of giving you an answer that's not sexy, I rely very heavily on our quantitative development team.
All right.
We're talking about dozens and dozens of quantitative developers that support our strategy, and also make my life as a portfolio manager and as a researcher in these strategies. We are continually trying to improve these strategies, make my life doing those things easier. We've done more excellent research in trend following and portfolio construction, signals, transaction cost management over the 19 months I've been at Fidelity than I have in the 5 or 6 years before that. And it's because we have so much support. Quant developers have been a big part of it. Our operations team that supports all of the instruments that we trade has been critical. And our trade desk has its own quant team. And one thing that's not always obvious is that transactions cost, how much you pay to trade when you trade a lot, matters a lot. And so markets have sort of a bid-ask spread, an amount you pay to execute. And if you're not careful about how you execute, you can overpay to trade, and it can really take away from returns. And so having a trade desk that really understands that and is observing and watching that and is actively sort of constantly trying to improve execution as they observe how things have gone is a big part here. And this is the first time I've been in a firm that had a big quant capability on the trade desk.
So your trend following key part of the strategy. So I'm curious, why do trends exist and persist? And if in your answer you could reference psychologist turned behavioral economist Tversky and Kahneman, I'll give you extra credit.
So whenever I get this question, I turn it back to the person that asked the question, and I ask a question. I say, how do you feel when you're losing money? Let's say you wake up tomorrow and your retirement account is down 7 or 8%. How do you respond to that?
I'm feeling not so good.
right? Even though we know intellectually that this is the a realization of the risk we're being paid to take by holding stocks in our accounts, we feel when the market falls more probably than we ought to. In addition, if we go to a cocktail party and our friends are talking about having made a lot of money on some stock, we are likely, if we don't hold it, to consider going out and buying it, and probably more than we ought to, right? The, if I own an index fund, I may already have a bunch, but because of what I've seen recently in its recent performance, I may want to go buy more, even though if in a rational environment, a rational market, it's already priced in. So I think it's those behavioral biases, and I'm subject to them too, right? When I see a position that is down significantly or going against us, I feel it in my soul. And so I think the human condition is such that we tend to cut losses, or reduce exposures at the worst possible times because of those psychological biases that Tversky and Kahneman documented so effectively. And originally they were laughed out of academia, but they ended up being dead right. It's behavioral biases that drive a lot of what we're trying to exploit in managed future strategies.
Now let's move to strategy implementation. What are the signals your models rely upon to identify a trend? Give us a little more granularity there.
At a high level, it is as simple as if markets are going up, we want to be long. If they're going down, we want to be short. But the details are a bit more complicated than that. Let's say you only have one signal. Let's say you look at whether returns are up or down over the last year. If you only have one signal, then your outcome is determined by the parameters of that one signal that I chose. And you really don't want your investment outcome to be determined by one little decision like that is frankly somewhat arbitrary, right? Maybe 240 works well and 270 works well, but you chose 250. So we want to
And
have,
Rob, for clarification, you're talking about a days long trend that you're following, a 240
right,
day trend.
exactly. I'm talking
Yep.
about the number of historical business days that you're looking at to determine a trend.
Yep. Yep.
And so the punchline is that number one, you want to use a lot of signals because you don't want to take any sort of risk based on having made some arbitrary decision around parameters. Number two, you want to have different kinds of signals. Specifically, classical U.S. Trend following strategies use something called momentum, which is just a historical return on a market. There are some bells and whistles you can do to make that a little bit more effective, but it's basically the historical return of the market. A more European style strategy would be a moving average crossover. So you look at the average price over a short horizon and a long horizon. And if the short horizon is above the long horizon, it's a positive trend. If the short horizon is below the long horizon, that's a negative trend. There's a lot of different approaches you can take to sort of forward loading those signals, called exponentially decaying the signals. And you can combine many signals. You can also eliminate or reduce exposure to signals that look like they're overextended. So there's roughly 250 different signals underneath the hood, but all they're trying to do is get a very diverse perspective on whether markets are going up or down. Some of the shorter end, the signals on the shorter horizons are really, they're not determining our direction, but they're tempering it, right? So if markets have begun to fall over the last couple of weeks, we are reducing exposures to what was all otherwise a positive trend. So faster moving signals are really there to temper the average. They're not there to sort of determine our direction. It's not a short-term trading strategy, but it does include some short-term signals for risk management.
Okay. Now let's shift to portfolio construction and what you just mentioned, risk management. How do you construct a cohesive portfolio, and then how do you contend with the inevitable and challenging, V and W shaped markets? And we experienced one not that long ago.
So the first thing is to recognize that those are the V's and W's occur, and you don't want to overfit to them. So we have to keep in mind what the portfolio objective of the strategy is. And if the portfolio objective is to be complementary to the things that investors hold in larger size in their portfolios, then when markets turn over and begin to fall, if they continue to fall and we're short, we're doing our jobs and we've actually helped their portfolios overall because they're probably long on average. However, if markets recover from a steep decline, and we saw that in April, the investors overall are happy, right? Most of their portfolio has done better because of that recovery than it would have if markets had continued to fall. So if we're caught wrong-footed following trends, that's one of the shortcomings of driving the car, looking in the rearview mirror. We have some mechanisms that help us, avoid going whole hog into positions that uh, have changed recently. Basically, I would describe it as being a little bit patient about entering trends, and also having an eye on if we're positioned differently from how very short term market action is unfolding. So let's say we're long and we see that markets have drawn down by 2 standard deviations over a couple of days. We would potentially reduce exposure to longs in that scenario, but not by going all the way short, but by potentially at the margin reducing exposure to markets where we're wrong way versus recent action.
It's intuitive to me that a trend model could respond to an observed pattern, but it's not so intuitive to me that it could discern the end of the trend. Maybe you could talk about the speed and confidence of trend signals, and how does your model pick up on a reversal, and what happens if there are contradictory signals? How do you resolve them?
There are almost always contradictory signals,
Yeah.
and that we have some fancy version of averaging that if some of our signals like something and others of our signals dislike it, we have low confidence. So there's this notion of conviction and a separate notion of direction. And so if we perceive direction with low conviction, we are invested in that direction, but in small size. If we perceive direction and conviction, we are invested in that direction in large size. And when we think about how much exposure we have overall, we would call it a volatility target or something like that. We're taking more exposure. We're seeking larger outcomes in environments where we have more conviction, and we're seeking more exposure to markets where we also have more directional views. So that's allowing the portfolio to scale up or down exposures based on environment. There's nothing harder to explain to an investor than why you lost a bunch of money in something that was barely trending or where you had relatively low conviction. And so that was another underpinning of how we designed the strategy. We just didn't want to have that conversation. We
Right.
want to be in trends where we have high conviction.
You touched on this a little earlier, but maybe there's more to talk about, which is under what types of market conditions is a managed futures strategy likely to produce favorable returns and unfavorable returns?
I think you nailed it on the unfavorable side with your questions about V's and W's. So if markets are trending strongly in one direction, when I say strongly, I mean such that our conviction is high that there is, in fact, a trend, and we're likely to have meaningful positions in seeking exposure to those trends. If that reverses very sharply, we won't. There's no question we're going to be on the position the wrong way on day one of that, and probably on day two of that if it continues. Because the punchline is that we're trying to assess from the data what the likelihood is that the trend is really reversed, and markets are super noisy. And so it takes more than a couple of observations for us to get conviction that something really meaningful has changed. So those V's are tough. A W is actually three V's, which could make it even harder. We're not so concerned about flat environments. A flat environment, persistently flat, is actually okay for our strategy. And the reason is because a flat environment typically generates very low conviction trend signals and is good for the types of investment decisions we're making within asset classes. So we're pretty comfortable with even in environments where there's not trend, but things aren't chopping really significantly back and forth. The best setup for any trend following strategy is one where we go from a quiet environment where there's really, any big move up or down will begin a new trend, right? So we're looking out the rearview mirror and we see nothing. It's totally flat. And in that environment, the first tick up will cause us to begin to take more exposure long, and the first tick down will cause us to begin to take more exposure downward. If that happens and the floor doesn't fall out for another few months, that this is the 2008 scenario. Equity markets peaked in late 2007 and it began to trend downward slowly, and it took, almost a year before the floor fell out underneath of stocks. That is an environment that every single trend signal, no matter what the parameterization was, got right. And so what you'll see is that there was not a lot of dispersion across managers in 2008. They basically all did great. What's harder is an environment where, very short-term trend did well, but longer term didn't do well, and vice versa. We're set up to try to capture an average of all of those things, because we want to be right on average, and we don't want to take a lot of risk choosing a parameterization that is only favorable in one environment versus another. We want to be sort of as neutral to the type of parameterization or the type of trend that we're seeking exposure to. So when things are trending broadly, we're going to be fully invested and in the market. When it's not as clear, we're likely to have less exposure on and be less wrong if things go the wrong way. We're set up to really have a careful mix of risk management versus return seeking.
As we get closer to wrapping up, can you tell us about the current state of the market, and are there any new developments that are worth explaining?
There are always new developments in one of our 150 markets. The things that have been most helpful, our strongest view today is still short dollar, long foreign currencies. That's been the only type of exposure that's been really helpful and hasn't done a V or W over the last year. Commodities are a place where there's always a lot happening, but it's very idiosyncratic. So on average, today commodities are trending downward pretty sharply, and I would describe that as at least if they continue in that direction, it's going to be a great opportunity for trend following strategies. Equities, it would be hard to find a trend signal that's not telling you to be long today. But at the same time, our investors already hold a lot of long equity exposure. So we don't get really excited about sort of adding to that.
Well, Rob, this has been a great conversation. I find it really exciting that you've played a big part in bringing managed futures to Fidelity. So looking good, Rob.
Feeling good, Steve. Thanks so much.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of August 2025, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional, if applicable. References to specific investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMRLLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Commodity interest trading involves substantial risk of loss. The Fidelity Managed Futures ETF, FFUT, is an active ETF that aims to capitalize on market trends using disciplined, systematic, long-short investing across a wide range of futures markets. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV, and are not individually redeemed from the fund. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. The fund uses investment techniques that are different from the risks ordinarily associated with traditional equity investments and are considered complex trading strategies. Such techniques and strategies include the use of derivatives, short sales, leverage, and investments in commodities and commodity-linked securities. Short sales pose more risk than long positions. Because a short position loses value as the security's price increases, the loss on a short sale is theoretically unlimited. Regulatory bans on certain short-selling activities may prevent a fund from fully implementing its strategy. Leverage can increase market exposure, magnify investment risks, and cause losses to be realized more quickly. The fund's use of futures, forward contracts, options, swaps, and other derivative instruments may result in losses. The value of these derivative instruments may pose risks in addition to and greater than those associated with investing directly in securities, currencies, or other instruments, and may be illiquid or less liquid, volatile, difficult to price, and leveraged, so that small changes in the value of underlying instruments may produce disproportionate losses to the fund. The use of derivatives is a highly specialized activity that involves investment techniques and risks different from those associated with investments in more traditional securities and instruments. Moreover, a relatively small price movement in a derivative contract may result in substantial losses to the fund, exceeding the amount of the margin paid. The use of derivatives can increase the fund's risk exposure to underlying assets and their attendant risks, while also exposing the fund to the risk of mispricing or other improper valuation, and the risk that changes in the value of a derivative may not correlate as anticipated with the underlying asset, rate, index, or overall securities markets, thereby reducing their effectiveness. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Fixed income investments entail interest rate risk. As interest rates rise, bond prices usually fall. The risk of issuer default, issuer credit risk, and inflation risk. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Investment in Fidelity Managed Futures. Cayman Limited, an unregistered subsidiary, is not subject to the investor protections of the Investment Company Act of 1940 Act, and is subject to the risks associated with investing in derivatives and commodity-linked investing in general. The value of commodities and commodity-linked investments may be affected by the performance of the overall commodities markets, as well as weather, political, tax, and other regulatory and market developments. Commodity-linked investments may be more volatile and less liquid than the underlying commodity, instruments, or measures. Non-diversified funds that focus on a relatively small number of stocks tend to be more volatile than diversified funds and the market as a whole. These alternative investment strategies may not be suitable for all investors and are not intended to be a complete investment program for any investor. Commodity interest trading involves substantial risk of loss. Past performance is no guarantee of future results. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV, and are not individually redeemed from the fund. The SG Trend Index is designed to track the 10 largest trend following CTAs and be representative of the trend. followers in the managed futures space. The SG Trend Index is equally weighted and rebalanced and reconstituted annually. S&P 500 Index is a market capitalization weighted index of 500 common stocks chosen for market size, liquidity, and industry group representation to represent U.S. equity performance. The Financial Times Stock Exchange, FTSE, 100 Index is made up of the 100 largest companies listed on the main market of the London Stock Exchange by market cap. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services. LC, members NYSE, SIPC, and institutional advisory services through Fidelity. Institutional Wealth Advisor, LLC, personal and workplace investment products are provided by Fidelity Brokerage Services, LLC, member NYSE, SIPC. Institutional Asset Management is provided by FIAM LLC and Fidelity Institutional Asset Management Trust Company and Fidelity Diversifying Solutions LLC FDS. Before investing, have your client consider the fund's investment objectives, risks, charges, and expenses. Contact Fidelity or visit i.fidelity.com for a prospectus or a summary prospectus, if available, containing this information. Have your client read it carefully. Copyright 2025 FMR LLC. All rights reserved. 121596 6.1.0, 1.992, 123, 2.100.